Good morning, everyone. Welcome to the launch of the 2020 NAIOP Educational Series, Mind the Development Gap. This is our first part in a four-part series. This will be the multifamily session, followed in September by an industrial session, in October, office, and rounding out November with a retail session. The goal of this year's series is to provide a roadmap for managing real estate development risk and uncertainty in today's market and strategies for charting the future comeback post-COVID. We have a few announcement and event reminders before the program begins. We wanted to thank our series sponsors, our sustaining sponsor, Transwestern, our construction corner sponsor, the Whites Company, and our supporting sponsor, Polsinelli. I'd also like to recognize some of the people from the NAIOP Programs Committee that were instrumental in planning this series. Vice Chair Sarah Crute, Joe Zanone, Bob Blodgett, Lorinda Frederick, Ben McKay, and Judy McCullough. This will be an open discussion format, be a little looser than most programs you're used to. You'll be able to ask questions using the Q&A function in the Zoom.
Hi, I'm on.
Okay, great.
And links to all the speaker bios are available on the NAIOP site. And today's program will run until 9:30 a.m. This morning, our panel will be moderated by Terrance Hunt, Chairman of Newmark Knight Frank Multifamily Denver office, Scott Graber, Vice President of Multifamily and Senior Housing at Gershman Mortgage, Amy Hansen, Shareholder and Real Estate Practice Chair at Polsinelli, Carl Koelbel, Chief Operating Officer, Koelbel of Company, and Jarvie Worcester, Managing Director of Mountain States Trammmel Crow Residential. Welcome, everyone, and with that, I'm going to hand it off to Terrance to start the program. Terrance, you were on mute.
I said I'll never do that again, and I just did it. Thank you, Brian. Really appreciate it. Thank you, everyone, for joining us, and thank you, panelists. So we're going to get into multifamily development. We're going to talk about some of the things going on that are unique. You know, I've been doing this 25 years, and right when you think you've seen it all, you haven't seen it all. So it'll be very interesting to get some perspective from our panelists that have ample experience from different aspects of the development process. But what we thought would happen here, first off, is just set the table with what's going on in multifamily in Denver in general, and then we'll jump into the development aspects. So just to give you a quick overview, very briefly, on what's going on in Denver, we are seeing some trends emerge. If you look at the next slide, you will see that, you know, we're looking at supply and demand, obviously, those are things. And then we look at population dynamics really to fuel the demand. And then we want to talk about another type of demand. That's the investor demand, you know, who's looking to buy the product. So let's talk about the fundamentals first, and then we'll talk about what investors see in multifamily in general and here in Denver. So on the next slide, multifamily supply. If you've been in and around Denver for a while, you can't get away from noticing the cranes and the development of multifamily that's been going on for the last several years. That's one thing that investors have paid and developers have paid attention to, is the supply. The thing with this in the past, though, is we've been able to absorb it, and we've been able to absorb it fairly easily. So just to break down, these are the dots. It's hard to follow. Is a heat map of what's being developed. We have proposed, and a lot of the proposed you've seen out there for years and years, and a lot of those deals won't be built. What we want to pay attention to is what's under construction. What is actually going to be delivered? And right now we are seeing 22,000 units in the pipeline. To put that in perspective, we absorb about 10,000 units per year. It'll take the next 24 months or so to deliver those units. So we're right in line to where we've been with historic absorption. We should be fine. The question mark, which we'll get into in a second, is that absorption. So if you go to the next map, or the next slide, I should say, so we've seen robust demand over the years, but with that demand, an interesting trend that is counter to what you would think has established. We were down, if you add up all the permits pulled in 2019, coming off just a hot market of absorption, it is actually down 35%. And so that is obviously a leading indicator. I mean, we have the experts on the phone, but I'm sure they can attest that you need a permit to build an apartment. And those are down. So that is a leading indicator. And the other thing that we've seen down, which hasn't been down as much, but still down, is the single family. So we are seeing a trend of the permits being pulled that dictate future deals under construction actually diminishing. So we do have a pipeline of 23,000 we need to absorb, but we're looking around the corner on the other end, and we are going to set up for potentially a housing shortage. So let's go to the next slide. Another significant thing that keeps people from, moving out of an apartment because it's not transitional housing, we'll talk about it a little bit, is we just exceeded 600,000 average home price. And we don't really see much relief in that just because those permits are down in homes, and, Carl and some of his peers are, working to build more homes, but it just sometimes doesn't pencil. And with the combination of low interest rates and lack of supply, we don't see much relief on the average home price. So no real transitional gap in terms of condos being delivered. So it's either you're renting an apartment or you're coming up with a significant down payment and a big mortgage payment, even with low interest rates, if you want to live in a home in places where most people want to live. So next slide. So what does the demand look like going forward? Supply, we can look at permits. That's pretty easy to quantify, but what is demand? That's really the most opaque part of what is going to happen here in the near future. But if you look at historic numbers, if you look at the next slide, Denver Metro has been a pretty good place to be in the housing business. If you look at the steady growth in population, not falling off a cliff like some markets, really just it's the degree of what you're going up. I'll flatten out for a year or so and then continue. So our year after year growth is strong, and the population base is strong. And if you look at historic sense, and I think Denver's more livable than it was even in the past, and we're garnering more attention than we ever have in the past. So this should continue and potentially even escalate. So all that looks good for the demand side. Next slide. Here's an interesting group we track, is the apartment list. And what they do is they look at apartment searches on the web for people looking outside of their current MSA. So if you're looking out and not moving down the street or the next neighborhood next to you, you're looking outside your MSA. So Denver led the nation in searches for people looking outside their current MSA. So that signals that people are interested in Denver and like Denver and are at least looking to move here. If next slide shows where those searches are coming from, a lot of them are the major metropolitan areas, but interesting, we had a large amount when they did this from Washington, D.C. If you rank it on where people are actually moving from, most recently it's been New York, and that's been, statistically they've been at the top because of a large population. But when we're talking to managers of the buildings, and even in the last week, where you see most of your people come from, it's always been out of state. A lot of it's been from California, but now they're saying New York. We're still saying New York, Chicago, San Francisco, Los Angeles, Washington, D.C. So still a lot of people from these major metropolitan areas, and in today's environment where those dense cities are having some issues, and we're seeing record vacancy in New York City, they are moving all over, and the mountain states are faring fairly well in terms of being the recipient of that population. So that's just some of the supply and demand factors, which we'll dig into some of the reasons and how developers are looking at it today and going forward. Let's talk about overall investor demand. it's just briefly, been doing this a long time in Denver. And I do remember when I tried to sell this cow town to a lot of people with national and international capital. And now they are finding us. At Newmark, we do a institutional call nationally about 2 or 3 times a week. And we've been doing this since March, just talking to investors and what they're looking for nationally, every product type, every single city, 400 people on the call. And interesting enough, Denver, we've been on out of almost 60, I think it was 62 calls. We've been on 58 of them. So the investors are looking, even if they're not here, for multifamily in Denver. And so we're seeing a lot of the investors moving away from other product types into industrial, into multifamily, seem to be the most popular food groups now. And then they're also looking at other locations like Denver and shying away for where a lot of them were relegated on the institutional side was the coastal market. So the Denvers, the Phoenix, the Austins, the Nashville seem to be coming up on a regular basis, at least when we're having the conversations. So without taking any more time, we'll jump in and talk to our experts who Brian introduced already. But I'm going to let each of them just go ahead and tell us a little bit about themselves and the company they work for and what they do, instead of reading a big long bio. So why don't we start with Amy? And Amy, if you could go ahead and give an introduction, and we'll go from there.
Sure. Thanks, Terrance. Amy Hansen with Polsinelli. I'm a real estate lawyer, and I chair the Polsinelli's national real estate practice. We have about 100 lawyers across the country doing A to Z real estate, you name it. We've got somebody who probably has touched it more than once, to put it mildly. But my practice focuses both on just hardcore transactions, buying and selling operating assets, land, things like that, and also development. And have spent a fair amount of time dealing with condominiums, construction defects, some recent zoning changes and other things like that all impact the conversation today. So I appreciate being here and look forward to hearing what all the other panelists have to say. Thanks, Terrance.
Yeah, absolutely, Amy. Look forward to hearing from you. You've got a great skill set for what we're going to talk about. Jarvie, how about you?
Morning, everybody. My name is Jarvie Worcester. I'm the managing director for Trammmel Crow Residential here in the Mountain States, which today is Denver and Boulder. We have developed probably north of 3,000 units this cycle, have 1,300 in lease up right now and another 500 kind of under construction. Our pipeline looks about 950 or so units. Like Terrance said, we'll see on some of what is considered proposed. But my background is not just multifamily. I built condos and some resort product when I was with the resorts. Actually, Amy represented us. And also, one diversification we get into it often, we partner with folks like Carl's firm when there's an affordable housing component on projects. We don't claim to be experts in that type of product. So excited to talk more about what we're doing and hear from the rest of the panel.
Great. Thanks. Look forward to it, Jarvie. Scott, how about you? Let's hear from you about your group.
Good morning, everybody, and thanks for inviting me. I work for Gershman Mortgage. We primarily make construction loans and permanent loans on multifamily, senior housing. That would include assisted living, memory care, skilled nursing, and we do the occasional hospital financing. Few and far between, but we did a decent sized one in Grand Junction this year. But my primary focus is multifamily development, more on the market rate side. But we, as a company, do a fair amount of affordable housing finance as well. So, and most of it's done through the FHA's insured loan programs. So,
awesome, Scott. Thank you. And Carl, we've known Koelbel family here in Denver a long time, so he's done a great job taking the baton and taking it to the next level. And still best dressed. I haven't seen a tie in a while, so I appreciate that too. You're looking great. Carl, why don't you tell us a little about yourself and Koelbel & Company?
Yeah, so Koelbel Company's been around since 1952, really focused primarily in Denver, and we generalize in sector type, but focus in Denver and Colorado. We've done everything from resort development. We've got a property right now in Winter Park still called Rendezvous that hopefully won't burn down like everything else seems to be attempting to so far this year. We've done a collaborative office deal in Rhino called Catalyst. So we're in an office space. We've got some legacy land holdings that we're doing sort of being B office and flex space, and we've got a lot of retail, which is interesting. But we've also been doing a lot of affordable housing using low-income housing tax credits. So we were averaging one of those projects a year starting about 10 years ago. So I think we've delivered more than any other private developer in the state over that period of time. We also have a portfolio of some older market rate properties. One we built in 1972, we still own, and then we're still part of the investor group at the Breakers, which is now Tava Waters, which was a property we developed in the early 90s. And we're looking at a market rate deal on a master plan TOD site we have at Parker and Peoria right now. So we dabble in a lot of different areas in real estate development.
Absolutely, absolutely. And Jarvie and I, as homeowners in the Grand County area, echo, hopefully it doesn't burn down. Yeah. So anyway, we're going to jump into some questions now. And since this is an educational series, just to get, some perspective on what it takes, the whole process on the development side, walk us through, and I'll start with Jarvie, walk us through the high points of the process of multifamily development, from identifying a piece of ground to delivering the product. Jarvie, if you can just kind of give us that background of what your day-to-day is and soup to nuts in a nutshell.
Sure, and obviously I'll stick to high points because there's probably a 4-part series just on that. And Carl will give some different insight based on the different food groups that their company goes after. I think for a lot of multifamily developers, there are some limitations on product type. For our firm, we range from 3-story walk-up up to high-rise concrete structure. So that opens up some broader locations for us. But high points on that side is Terrance, really, what's the product type we want to focus on? What neighborhood and areas within the metro area do we like? Do we feel demand is coming? And then we get into a lot of specifics about a site. What's the zoning? What's the mill levy, which is has wide ranges, almost 100% range from Denver to say parts of Aurora and mud districts. What sort of rents are out there? What is the development environment? Boulder is very different than Denver, as everybody is different than Lakewood is different than Golden. So we try to stay away from some of the more challenging municipalities from a development standpoint. We do have a deal in Boulder that was challenging, but there's also pluses that come with that. There are big barriers to entry. But then, without getting too far into a pro forma analysis, there are several kind of assumptions that we have to chase. Construction costs over the last 4 or 5 years has been the most challenging because it's been moving at a rapid pace. But we triangulate the formula for costs and what we think we can rent. We lean on folks like you, Terrance, to advise us on where cap rates are going from an overall analysis. And from a drawing standpoint, we progress from a very, I'll say, pretty picture and a concept review all the way to construction drawings that tells our construction team where everything goes and how to build it. Along that while, there's obviously a lot of risks to mitigate. Early on, we're mitigating site risk for entitlement, for environmental and geotech, which can be somewhat variable on a site. We're also checking boxes from an overall entitlement and zoning standpoint. And as I think everybody knows on this panel, and Scott particularly, understanding where equity and debt are on a project life cycle is critical. As a firm, we have a healthy balance sheet behind us, but we bring in LP capital and we lever up to 60 to 65% construction loans on each of our projects. We need to know that those opportunities are there very early on in the process so that we don't get too far out over our skis and find ourselves with a lot of money at risk on a project. Then, the obvious part, or I should say the more straightforward part typically is the building permit process, and then through construction. We self-perform most of our projects for Trammmel Crow Residential, so we're building it ourselves. At times we use third-party general contractors, but that's sort of the high points, Terrance, from kind of site identification, permitting, and Carl, hopefully you can point out what I missed and the variability of the different product types that you guys focus on.
Yeah, and yeah, since you build the affordable, I know that's a little bit different process, Carl. So if you can touch on, same question asked to Jarvie, but also put some focus on some of the other unique product types you do from affordable and even some of the
Yeah, so generally, and then I'll get specific on the affordable, we view site selection almost like a funnel, right? You get a lot of sites you look at, you kind of see, right, if the yield study and the costs line up with what the rents are. And then as Jarvie says, you've got to know that you can finance it. And along the way, you're just slowly inching your sources and uses closer together until you feel like you have a project. It's similar on the affordable side. One of the differences though is the cycle for the affordable is a little longer, right? Because in most cases we're chasing low-income housing tax credits that are competitive, and there's an award process that happens one time a year. You apply in April and you find out in June, right? So if you're signing up a site in March, you got to wait 11 months before you can apply, and then another 3 or 4 months before you even find out if you've received the credits. And then from there, we typically don't close on the land until we've got the financing in place. So it could be on some of these projects, especially if you don't get credits the first round, which would be unusual to get them the first round, it's 3 or 4 years from the time you've identified your site until you've closed on the land. And so typically what you need is a motivated seller. And by that, I mean somebody that has to build affordable housing. So in a case with Jarvie, and we've worked with Trammmel Crow on 2 projects up in Boulder, there's a huge payment they have to make to the city for the affordable housing program up in Boulder. And we come in and say, look, you can make less of a payment to us and we'll go ahead and build them for you. And then we go get the tax credits. But what you're seeing in a lot of municipalities now, whether it's Lone Tree or Westminster, name one, right? It's kind of all over the place. If you go in for a big master plan community or zoning, they're going to ask or require that you have a certain amount of affordable housing as part of that. And typically what they have in there is you will deliver affordable housing by this point, or we're going to come in and take some land, or in other cases, we're not going to give you TIF funds, or we're not going to give you the ability to pull commercial building permits. So they are very motivated, and they are stuck with somebody like me that's going to focus on the affordable housing. So I can go in and negotiate a 2 or 3 year option with them and say, look, I'll go get you the credits. I'll help satisfy this requirement, but it's going to take some time, and you're going to need to be patient while we do that. So right now, that's how we've found the majority of our sites. They come with a requirement of affordable housing, or otherwise an offset from a private developer. And then really the question for us is how many units can we fit on it? What is the type of tax credit that we're going to? And there's pretty varied. Most cases, it's the competitive tax credit. And then we look at it and go, can we, I use the phrase, walk through the financing door? Low-income housing tax credits are a little different. You have really no market risk. You know what the rents are going to be because you can look them up online because they're prescribed. So once you feel like you've got enough sources on your financing to cover the uses of the construction costs and the land and everything else, then you feel like you've got a project and you just kind of get going. And once you get credits, you're on a mad dash to put it in place as fast as you can.
Great. Okay. Well, thank you both for that insight. Now, your advisors that, try to keep you on the rails along the way, both on the debt and the legal side. We'll start with you, Amy, and ask you the same question, Scott. What are some of the common pieces of advice you give your clients when they're entering into or in the development process as it relates to, for you, Amy, the legal component? Is there something you've seen reoccurring and say, hey, make sure you check this? Or what are your top pieces of advice you give your clients that are in the development process?
Yeah, I'll focus on, let's say somebody new to the market comes and hasn't been in Denver. I think one of the things, or the Denver metro area, I drive home is the timeline. The timeline here can be long. The NIMBY factor is high. Just working through the city process can take quite a while. And I think there are people that are new to the market that are surprised by that. And are, the sentiment and the politics around getting a project approved can be difficult. So I think that's sort of the first thing if somebody's new. But then for any client, I typically ask about equity sources, because I've seen deals, and I think given where retail is, for instance, if you're going to have a first floor retail component, understanding if your equity sources will support both the multifamily and the first floor retail, because if they won't, you may have to bring in different equity players, figure out how to separate those components out, and do some creative things on how you get the project built. And then kind of finally, I always ask about exit strategy. And, given the construction defect realm, I think a lot of people, especially people who are new to the market, just think that they could sell to anyone. They could sell to a converter, they could sell to an operator. And I think, people just need to understand at the outset that they need to be thinking about that from day one in, how they, get insurance. Who do they contract with to build it? What does that construction contract say? And so really thinking about that exit strategy at the front end, if you don't think about it, your hands may be tied a little bit on how you can exit. But those are kind of three main things that I tend to hit on.
Right. Scott, what are you looking out for and advising on the debt side?
Demand is probably at the top of the list in my world, and followed by developer experience and development team experience. We've got a lot of in the Denver market. It's pretty hard to find construction financing that makes sense. Going to the FHA can be problematic, and especially in the CBD where there's a lot of building that's going on. So the tertiary markets are the really only opportunities exist from the HUD's perspective. As far as the development team goes, we really have to take a close look on their experience, see how well they're capitalized internally, whether or not they have the funds to close a project outside of LP equity. Some of the biggest hurdles that we're running into right now on the construction side is that construction timeframes are being extended due to material shortages, and labor shortages. So, if we see a developer with a short construction time frame, we almost automatically require that they add additional months to it. I've gotten into all kinds of arguments. I don't call them arguments, but just conversations with CMs that say, look, there's no way that we can stretch this out because this is what we're going to do in this time frame, and regardless of where they end up, we end up adding months to the construction term on most loans. We also look at reserves requirements to service the debt beyond construction, and to ensure that the stabilization process or stabilizations occur without too many hiccups. Just making sure that the rent levels that the developer's contemplating are reasonable and are consistent with the building type. The cost to build is, depending on where you are, is pretty much the same, depending on what, the cost to build different construction types varies, but a garden style apartment is going to cost X amount of dollars in this county and that county. Your permits and entitlements may vary, but the actual construction costs are going to be fairly the same. So if you are looking to enter markets where the rent levels are fairly low, but the construction costs are are almost static, we start to get a little bit nervous on whether or not that project will actually make sense.
Got it. Okay, well, it sounds like just trying to verify as much as you can up front, knowing that it usually takes a little bit longer. That leads me to my next question. Really, I spoke about this before. It's really the multifamily demand has been great overall in Denver. However, that number of permits that started to fall in 19 has continued to decrease, really demonstrating that there's hurdles to get deals done. Jarvie, tell me, what do you think some of the biggest contributing factors are in this decrease in permits?
I mean, I think the obvious one, Terrance, has been the run up on construction costs over the last probably 3 or 4 years, making deals a little bit thinner and more difficult to capitalize. I mean, I think also the availability of sites and sellers with realistic expectations as construction costs have moved, rents have moved a little bit. Sellers' expectations on what land is worth have not. So I think that obviously then leads to more, as Scott points out, more challenging debt yields and everything that factors into equities, interest, and debt. I think it also it probably had a harder hit on sponsors without significant balance sheet and a guarantee, as Scott pointed out. Some sponsors without the financial capacity to take on some debt in these projects were and are not able to get projects financed as easily as they were 3-4 years ago, which thins out the developer base and therefore the permits. I think that's sort of my high level take for folks like us. It's actually an exciting time because we can still continue to get deals capitalized, and that dip in permits obviously translates into a decrease in supply, which means deals that we're doing now should deliver in the right time frame from an overall kind of apartment demand standpoint.
Right. That makes sense. What about from your chair, Amy? What challenges you see out there that can contribute to that? Just entitlements, so forth. Is anything happening there?
I think the cost to develop in terms of what municipalities are expecting developers to pay for just continues to grow. There's and we all can agree that affordable housing is a huge issue in our community. But the affordable requirements that are layered onto projects, in some respects, can result in fewer units being delivered, which makes the market rate units just that much more unaffordable. And so I think there's the projects get harder and harder to pencil when you factor in the land costs that Jarvie spoke of, and then you start to layer on all of these other development fees and exactions. It becomes a financial equation, unfortunately. And that's the reality. And I also people will hear me say this, that time kills deals, right? The longer it takes to get a deal put together, from a zoning and entitlement standpoint, time kills deals. Unless, as Carl said, you've got somebody who has to put in affordable, and those deals just take forever anyway. But I think that all of those factors compound. But if the fundamentals aren't good enough because there's just not enough supply, and you can command the rents, then it becomes worth it to deal with all those things at some level, as we're seeing.
Right. And Carl, same question to you, but in perspective, we've seen just escalated demand, and every municipality saying we want more affordable housing, every politician pounding their chest for it, but it doesn't seem like it's flowing like everyone wants it to. What are some of the, issues with that where you're not seeing that being delivered as you once were, even though the demand's up?
Yeah, I mean, I think the biggest one, which is kind of always the case, is there's never enough money to do it, right? So the municipality said we want a lot of affordable housing, and you turn around and go, great, I've got a great site. Well, I need a $500,000 loan from the city, and they will kind of laugh at you. And they go, no, we just wanted affordable housing. We didn't want to pay for it. So that happens pretty frequently. Some cities, and I agree with Amy, the folks that have large extractions on the multifamily side are, in a sense, putting themselves behind the 8 ball. Boulder, they've got the donut hole issue, right? If you qualify for affordable housing, you can live there if you're lucky enough to find a unit. Otherwise, you've got to make 120, 140% of the area median income to afford. And if you're in between 60 and 120, you can't afford to live there. But the biggest thing that we're seeing, and we're running into the same issues on the financing, on the construction pricing that the market rate folks are. The other thing that we're running into is the tax credits themselves are priced in an open market, and they are dependent on how much demand there is, right? So more demand, just like you would assume, more demand for tax credits mean higher pricing if the supply is limited. But one of the things that's surprising that we're seeing is folks are anticipating that we're going to be in a bit of a recession, and so we've seen the pricing drop 4 or 5% here in the last 3 or 4 months on the affordable housing world. So the sources of funds for us are actually getting a little more challenged as well. And we've got some similar deals, slightly different flavor to it that everybody else is dealing with.
Yeah. So you mentioned Boulder and the affordability of the market overall, and looking well into the millions in average home price, which someone said it's unique. I would say we like to call it 20 some square miles surrounded by reality. But overall, just in Denver, we have now hit the highest home price off a coast, so higher Chicago, anywhere else, just exceeding average home price of over $600,000, keeping people in apartments. There's quite a gap there. There's only been a handful of large condo projects that have been completed in the last couple of years, but they're extremely high end, and the price points aren't considered entry-level housing at all. Do you foresee any significant increase in attainable condo development? And Carl, I know you're building some condos. I don't know if attainable is a word in some of those locations you're building, but when you're looking at a condo project, why is that gap there?
So there's, the same thing that I'm sure Amy will highlight here, but the construction defect for a long time was the main culprit behind the lack of condo development. And what it meant was you had a whole cohort of attorneys that would follow these projects around, and then once they were open, they would identify some issues with the construction. Sometimes those issues were valid, many times they were not. And then go to the HOA board and say, look, you need to sue the developer. And then all of a sudden now the developers are roping in the general contractor and all the subcontractors, and they actually kind of decimated the industry. It was kind of like Scar and Lion King, right? When he ate all the antelope, there was nobody left. They sort of cleared the industry out. So I think part of it is it's taken a little bit of time for that to come back. But the contractors, if you've been to court over construction defect, you're not going to soon forget it. So there's a whole sector of folks that just refuse to work on condominium projects from a construction standpoint, and some even from a design standpoint, because they want to avoid having to get sued. So what it means is there's a smaller pool, and that pool that's willing to do it's going to charge more. So what you're seeing is that on top of even the accelerating construction prices, there's a premium for condos. So already you're ratcheting up, and you've got to build them at a higher quality with third-party inspection reports and everything else necessary for as a developer to protect yourself against it. And, I talked to a guy in California, and they've got similar laws out there, and he was doing condos. And I said, how do you do it? He goes, look, we put some money aside and we don't take it personally when we get sued, right? So it's sort of, people are viewing it as a fait accompli that it'll happen. And so it's just shrunk the industry a little bit. And the other thing that we're seeing, and so I guess the broad answer is, do we see more attainable housing through the condo market? My answer is right now in the immediate future, probably not. The things that you're most likely to get sued for on a condo building are water moisture penetration from the outside to the inside, mechanical issues, and sound attenuation. And so that's, hearing your neighbor walking around upstairs. In an apartment, it's annoying, but you know what? You don't feel like you're there permanently. If you've paid for a house, it's really obnoxious. So the reason I mention that is, to build attainable condo housing, you're going to build it out of wood. And the ability to attenuate that sound in between levels is actually more challenging out of wood. So one of the main areas you see lawsuits for is actually made worse through the type of construction that you're going to need to deliver attainable housing. I wish that we'd see more of them. We've seen some projects here and there, 30, 40 units. There was one on South Broadway that Littleton Capital Partners did that was selling in some units in the 300,000s. I wish there was more of that, but I don't see that industry coming back in a hurry. And the other thing is, we do a lot of for sale housing. It's attached housing. So on the spectrum of liability, on for sale, you've got a single family housing community that's got an HOA, and that's the least troublesome, all the way to an elevator served condo building. That's the most troublesome. We're kind of in the middle on the townhomes. Our insurance has gone up significantly in the past year. And so we're still struggling with that, because there are players that are leaving the Colorado market that are no longer willing to write policies for sale wrap policies in Colorado.
Right. Well, Amy, I bet you've had several clients sitting on the other side of the courtroom from some of these attorneys, and you're there alongside them. So elaborate on some of the things Carl said, and then tell me, and I think you have some interesting observations on just what else is contributing to the difficulties to deliver attainable housing in a condo side.
Sure. So I would echo everything Carl said. He's probably, I hope he hasn't lived it, but the developers who have lived through it are scarred. It hurts. And these cases are long, and they take forever. And so that market has definitely shifted. We do have, positive movement out of the Bellagio case, which allows, arbitration clauses, and also the legislation that was finally passed, albeit in a much watered down version, requiring homeowner consent in order to sue for construction defects, not just board consent. So there have been some positive movements, but we still don't see tons of condos coming to market. And one of the things that I think is really interesting is just in the financing arena, and I'd be interested in Scott's take, can you get rid of the pre-sale requirement? So if you have a high-rise condo building, you want to build 300-400 units, you go out to get a construction loan. If the lender, and that's call it, I don't know, Jarvie can probably speak to this better, but a 2-year process, maybe 3, if your loan has a pre-sale requirement and you've got to basically sell, 30, 40, 50% of those condos before you can break ground, that just delays the delivery of those units. So if I'm 30 years old and I'm, 28 years old and I'm looking to move out of an apartment, I need a place to live now. I don't need a place to live in 3 or 4 years. If I'm 60, I'm thinking about retiring. I want to retire downtown. I've got a lot of money to spend. My timeline's more flexible. I can wait 3 years for the delivery of a unit, and I have more money to spend. And so I think, that those pre-sale requirements can dictate the kinds of units that end up being marketable. And I know developers have tried to work with various lenders in various ways to get around a pre-sale requirement. whether it's financing it as an apartment building, or working with lenders that are perhaps not traditional lenders, but it's that pre-sale requirement, I think, can be a huge impediment to the high-rise type of building. In a 30-unit building in Jefferson Park or South Broadway, it becomes, the construction timeline's just not as long. And so it's just a little easier to deal with that if you've got that pre-sale requirement. But I've seen that be a real hiccup for folks.
Yeah, Scott. So that's, on the debt side, what are your thoughts on that when it relates to for sale product and challenges?
That's really out of my purview. Since I really focus on multifamily rental housing, I can only speak anecdotally. I think Carl brings up a lot of good points, especially with noise attenuation and then insurance. And you've seen developers try to game the insurance to some degree, thinking that if there's a certain amount of units, that it won't create enough critical mass to create a lawsuit that generates enough momentum. But still, the insurance companies have just been evaporating. And I've also heard anecdotally about development agreements at the land side, making sure that these multifamily projects can never ever be turned into condominium projects, and that's dictated again, I think, in large part by the insurance companies that are providing insurance for the multifamily development. Brian Levitt, it's a friend of mine, talked about his project at Lake House, and the price point for that is fairly high, even at the I think the mid sevens or something. And his response is that they are meticulous about the quality of construction that they provide to the buyer. It's just that he overbuilds to avoid the impending lawsuit. So I'm not sure how we'll ever get out of this, because there's just not enough momentum in the legislative process to really get us out of this bind. We've had a couple jurisdictions that have given that have given some leeway to a mediation process, but still it's a mess, and
and it is a mess, and I think it has gotten a little bit better, but I think we have to be vigilant that the progress that we've made doesn't get unwound by the legislature.
Yeah. And you bring up an interesting point, Scott. In the last cycle, we saw a ton of condo conversions, and now you see Amy probably advising her clients upon sale that she's going to put a use restriction on there, which is going to get you out several years. So that's going to be off the table, even if it did make economic sense.
Well, and Terrance, if I can jump in here, that was one of my points at the beginning, is exit strategy, right? If you want to be able to convert, you got to plan for that in your insurance, your construction contract, your design services agreement. If you want the ability to sell to someone who's going to convert, you basically got to avoid that restriction at all costs. So that can cost you more money with your general contractor, with your insurance, but you need to know that ahead of time.
Right. Great points. Jarvie, one last perspective on this. You've looked at pro formas on condos, on multifamily, obviously a lot. Aside from all the defect and insurance and all of that, just the economics, how does it compare? Because a lot of people are looking at sites and said, still the economics dictate for various reasons multifamily over condo.
Yeah, and as I was listening, I was just sort of driving home a couple of points for us. I mean, there's for strictly apartment developers, the limited supply of affordable or attainable for sale product has benefited us, right? There are barriers for a younger person to enter into a single family or a for sale product, and that leads them largely to rent. So the multifamily industry is obviously a benefit of that. That's just supply and demand. So while a benefit to us, I do recognize that it's a challenge for Colorado and many states. Having said that, to your point, when you layer in the construction costs and the insurance and the legal and everything that rolls into condo development, and then you look at sort of the cost to build an apartment project and the value that we create and exit at based on kind of where capital markets have been driven to, the pro forma says build the apartment, for a couple reasons. And we look at it from just sort of a steady, safer place. We look at multifamily as an opportunity where if things don't go as planned, you can typically rent out your apartments at a price. It may not be the price that's in your pro forma, but it's at a price that you can typically cover your debt service and ride through a tough patch. But then you also look at tax treatment on a condo versus an apartment exit. That condo exit is treated as ordinary income. The multifamily exit, assuming it takes you a year to stabilize and you've been in a partnership for years, you're exiting at a capital gains treatment. So there's anywhere from 10 to 15%, depending on the state that you're in, that you can profit from. So your profitability just tends to erode on a condo deal, which based on how expensive it's gotten, has just made some of those condo margins a lot thinner considering the risk.
Yeah.
That's why I think, like you said at the entrance, the condo development we've seen is in the upper end. It's in resort environments where there is a healthier margin for the developer.
And it's type 1 construction, to Carl's point, and just it costs more, you need to sell for more. Great. We're going to jump just real quick question for you, Scott. Just, how's the debt and equity markets today? We see interest rates remarkably low. We do see a ton of demand for the product type and the city. How is that cooperating today on the development side?
We are as busy as we've ever been in our entire existence. Construction interest rates for non-recourse 40-year fully amortizing loans somewhere around 3.1% today. So there's very, very few projects that aren't going to be cost constrained, which is an ideal mortgage constraint in my world. And when the virus hit, things shut down and things were a little bit quiet, and HUD started implementing some risk mitigation techniques, I guess, or so that they account for labor shortages, the material shortages, lease up risk, et cetera. But, and I think one of the reasons why we're getting so much business is that the banks have kind of just pumped on the brakes a little bit. So it's very interesting to see how much deal flow is coming through. The federal government has stepped in this particular instance and is providing insurance. I think they look at it as, one, providing liquidity to the marketplace, and two, creating jobs. And so they're serving two roles, and they are continuing to approve projects in a market that is, a bit scary. We've seen massive vacancies in some of these larger metropolitan areas. We've got a very, very large project in Oakland that the government is still, standing behind. On the flip side, the equity markets are unique. They're prudent right now, and so they are, in my experience, kind of sidelined to some extent. And what we've seen recently on 3 projects this year is crowdfunding come into place into direct investments into multifamily projects. And it's interesting to see that take place. The typical joint venture funds that are active in the marketplace are a little bit more quiet. and Carl had made some remarks about equity pricing on the credits, which is pretty poignant, right? I mean, if we're reaching recession and there is no profit to shelter through the tax credits become less attractive to the end users. There's always the CRA buyers, but still that does have an impact. And so we have to deal with the tax credit equity world, both in the LIHTC and the historic, which has always got some sort of ruling or something that's changing its characteristics. So, but for the most part, and particularly in our world, it's a massive influx of applications that we haven't seen. I mean, 5 or 6 of them last week. So, and I work on a national level. I don't work as much in Denver just because there's just, we've got we've had so much development, and I tend to work in a lot of the tertiary markets, and it's just a massive influx of applications.
Right. Moving up on the hour, so we'll start blowing by this, but any perspective on debt or equity from Carl or Jarvie, just on what they're seeing on their projects?
None that hasn't been made already for me.
Yeah, I think quickly we've continued to see equity interest on the construction lending side. Seems to be more regional than some of the big nationals that we typically do business with. But I think conversations are starting to come around on that front.
Right. Okay. Well, let's jump into another one of the hot topics. We've heard a lot of discussion about the whole COVID-19, how that's going to impact society going forward. We know when you're in the midst of it, sometimes you'll overreact, but the work from home, outdoor living space, less density, et cetera. What are your thoughts on that and how that may change your layouts for properties you're looking at going forward? Carl?
So I think, for us, and we do a decent amount of commercial, so I'm living it from both sides. I think for us, it's not going to change our layouts too much because we typically do try to provide an office space or a little nook for an office in what we're designing. But I think you're going to see people really now requiring that. And when we look at it, it's really making us look at where we build more than what we're building necessarily. I think the message nationally over the last 6 months that a lot of people took was get out of dense urban environments. And I've certainly seen that anecdotally from the number of unsolicited resumes I get from people out of New York and San Francisco and the like that want to come move to Denver. But we're also seeing it in traffic in our for sale units, right? So we've got properties near the Buckhorn Exchange, so not far from Colfax and downtown. Another property over near Cheeseman Park, similar deal. Our traffic has just plummeted as some of the challenges with these downtown urban environments has continued to persist. Conversely, we're having our best month ever up in Winter Park in terms of in our resort community up there. We are putting homes under contract so fast that we're not sure we're going to be able to keep up with the demand, which is the first time we've ever had that in the 20 years we've been doing that project. So people are committing to getting out of the city. Not all, and obviously not all of those are primary home buyers. The majority aren't. But a lot of folks are saying, look, I need a spot that I can go to get out of the city. And so we're seeing that. And what it means for us is we're going to be looking. People still love Denver. They still love everything that Denver has to offer. We generally prefer west side of town right now just because the people that are moving here for the mountains. And if you can cut that commute down by 30, 40 minutes by being closer to where they want to go, we think there's a benefit there. And we're also, looking to places where you can provide a little bit more outdoor space because if you're stuck in your home, you want to be able to get out and have that opportunity to let your dog out without having to take him out for a walk or just hit outside. So that's kind of what we're doing. And it's changing more necessarily where we're looking because I do think that the problems downtown, the memory will linger for a little longer than maybe people's behavior is. And just a quick aside for us on the commercial side, it's our expectation that there will be a decrease in office demand. And I say that to illustrate there'll be more people working from home, because there are certain parts of every company that you don't necessarily need them in the office to build culture, right? We love our folks in our accounting department, but they don't help us innovate necessarily. We need them to be efficient. And for some people, they can do that just as well from home. So I think you'll see some companies looking at this going, we think there's 2 or 3 divisions we can rotate through, and we'll see a decrease in office demand. But conversely, what it means is there'll be an increase in demand for folks wanting functional home offices in where they're living.
Right. Jarvie, with your design, how are you looking at it long term?
Yeah, some similar thoughts to what Carl said. We had already been heading towards more kind of co-working, work from home spaces in our buildings. Pre-COVID, we were seeing anywhere from I'll say 15% of just residents actually working from home. Those residents who travel and then work from home Monday or Friday, that also kind of increases us to 25 or 30%. So we had already been trending that way. We do resident surveys. We did a COVID resident survey. It was the most responded to survey we had. Similar concepts, more room for a desk and office kind of space at home, amenities. But interesting about amenities, I think we all know residents always want amenities. They're sometimes not as utilized as what they think going into a lease, but more outdoor space and things like that. What we're trying to sort of react to is the kind of immediate wins that we can go after. I mean, obviously, we talked about these projects are 2 or 3 years in duration. So what we're planning right now, while I think, like Carl said, there will be a lingering COVID impact to our society, it's not going to be as heightened as what we're experiencing now. So just being conscious of sort of not building the church for Easter Sunday on some of this stuff, because a lot of that does lead to costs and therefore rent, but just sort of absorbing what are truly impactful changes to design and what the resident experience is like. And to what Carl alluded to, Jarvie, in terms of location, has that altered, suburbs? I know you're urban, you're suburban, you're Boulder, you're all over. How has that changed at all with this whole thing? Are you looking more suburban, or is it just economic? Yeah, I mean, we had sort of been looking a little bit more suburban over the last couple of years, just from a kind of a product type and a basis standpoint anyway. We're actually closing our deal over by Stanley Marketplace today. If I seem a little distracted, but so we had been heading that way a little bit. I think basis is a focus. And supply is a focus. We've been heading a little bit away from urban product in our pipeline, just relative to where a lot of the supply was coming. But I think, and this is an anecdotal comment, but we don't want to venture, because of the timeline to deliver these projects. We're not hell bent on straying too far, because a lot of these folks who are picking up and leaving New York City don't necessarily want 3-story garden product in the burbs. They want kind of urban living in a city that's just not as dense as New York. So we still see, we have still seen pretty decent traffic and leasing on our 2 downtown assets. We've done some things on concessions to get them there, but the proof is in the execution of lease, and we've still seen that. So I think there's sort of 2 tiers to that migration, right? There's some folks coming from really dense cities that still want to have an urban environment in a city like Denver, with the ability to get out and play in the mountains. And then there are also some folks here in Denver that do want a little bit of a suburban option, and we're looking at that as well. Right. Okay. Anything else to add on from anyone else, or even Carl? Just on locations and types of suburban locations, or what people are looking for?
And yeah, I mean, I think, the nuances, we're doing mostly for sale on that front. And so that's why, I said we're looking a little bit out of the city just because, on the for sale side, I think it's a little different than folks moving in from New York trying to figure out where they want to live. But I think that's real as well, right? If you're coming from Manhattan, 3-story walk up in Thornton is maybe not, the culture shock you're wanting. So you'll find a good middle ground there. But if you're making an investment in a home, I think your mentality is maybe a little different, wanting a little more space and a little quicker proximity to the mountains.
Right. Staying on the whole COVID impact, Amy, let's move to you and some of the legal questions that are out there. We've seen contract changes, the old force majeure, and how that plays out through this. Thoughts on eviction, moratorium, so forth. What should developers be prepared for here going forward?
In no particular order, I would say that there's never been more research done by lawyers on force majeure clauses ever in the history and until now. And so, those cases, those disputes are so dependent upon the language of the force majeure clause. And so I think if you've got an active deal, you really have to look at those clauses. Also seeing, construction delays and other kind of things come up, which are force majeure in nature, but you've got, who's responsible for cost overruns related to those delays. So those issues are coming up. On the, once the product is built and you've got an operating asset, these eviction moratoriums, they're not at least I think universally, they're not a forgiveness of rent. It's just a stay on when you can evict somebody. And I think that sometimes that's a misperception among tenants. And, the thing that, my clients are all saying is, it's not like there's a holiday for me to pay my debt service, right? And I know, there might be some programs out there where, you can work out a forbearance with your lender or whatnot, but I think we are still to see more impacts on the multifamily market and properties. And this makes, the drive to the higher end product, I think even, more compelling because not all of us are working from home, but some of you are in your offices, but those with higher incomes have generally been able to weather the storm better. And so, those units that are commanding the highest rents, I would assume they're performing better as well. But that's probably a Jarvie or Carl question. But it's going to be really interesting to see how this all unfolds. I think there's going to be some distressed assets, which means there's some opportunity for some folks as well.
Yeah, and what we've seen on rent rolls overall, there are some people that aren't paying. Managers have identified some that aren't paying just because they don't think they have to pay. And there's some people in some tough situations, obviously. So it's not an easy thing to get around, but overall nationally, and especially here in Denver, collections have been much better than people anticipated, well into the 90s. So that's worth noting that people are getting support and they are applying it to rent for the most part, with some exceptions.
Well, and I think, quite frankly, that is probably a testament to the fact that the additional unemployment dollars have truly helped for those people who really are in need and have been severely impacted by the pandemic. Those additional dollars have helped pay the rent and keep them in their units.
Yes. So staying on the same topic of, this market disruption we're seeing, we do have a question from the audience regarding how has the Tax Credits and Jobs Act impacted pricing and demand for tax credits, is the question that came in. Carl or Scott, do you want to take that?
Yeah, so I think so. I'll just give a brief history. So it's my opinion that there's a lot of collusion in the tax credit market, and I think some people would disagree with me. But when Trump was elected 4 years ago, there wasn't even a tax bill on the table to be talked about. We saw credit pricing drop 10 cents that following week because they all happened. All of the tax credit folks were at a conference in Chicago, and I'm convinced that they sat down at a lobby in the hotel and started, writing numbers on a paper and saying, well, I'm going to 94. Where are you guys going? So we saw a hit then, and then it was pretty consistent for the last couple of years. And the reason that it dropped was just because people were anticipating the tax cut that did eventually end up coming. Recently, I think, and Scott alluded to it earlier, there are some banks that, because of the Community Reinvestment Act, need to reinvest in these communities. And they like doing it with tax credits because they get a return off of that. And that's one of the mechanisms that they have. And so those primarily have been the groups that have been willing to pay more for the tax credits because they can accept a lower yield on that investment than some of the syndicators or private high net worth folks that are trying to get a tax offset. What we've seen happen is the banks are now assuming that their profits will be lower, so their demand has dropped. And the other thing that is sort of floating out there in the market right now is it's a little bit inside baseball, but they're talking about fixing one of the rates for the non-competitive credits on the 4% side, which will actually increase the number of projects that have tax credits available. So it'll increase the supply of tax credits as we're having maybe a weakening demand for them. So that's primarily been what's driving the tax credit pricing down. The debt markets for these affordable projects have remained very healthy in terms of low rates, long amortizations. The debt coverage ratios remain low at a 1.15 or 1.17.
Got it. Scott, anything to add on what's going on in the debt markets in terms of COVID relief? And we do know there is some forbearance for owners that do have some hardships. You want to talk about that? You're on mute, I think, Scott.
Sorry about that. Yeah, so there is forbearance relief. It's kind of a double-edged sword because if you do accept it, you have to pay it off within a specific time frame, and you're just kind of kicking the can down the road, hoping that you can catch up on collections or that there's enough free cash flows to catch up on those forbearances. But what we're seeing across the portfolio of our servicing portfolio is fairly healthy. I mean, we really are in the 90s. And so we haven't had as much of an impact. People saying, look, I just can't pay, I just can't make my mortgage payment. And that probably is a testament to the additional unemployment benefits that were handed out, or not handed out, but that were given. And it's a miracle almost at some level. So, and I'll probably agree with some collusion on the tax credit front. I mean, this is definitely just an opinion, but some of these banks, because the banks will buy the credits and they're making the loans, and they'll give the loans away at a price that may be low, or the interest rates on the loan, but not giving the market value of the credit, and then that pushes the credit prices down on other syndicators or funds that purchase the credits that aren't attached to a banking institution. And it's a big problem. It's not talked enough about. It's probably beyond the scope of what we're discussing today. But something needs to be done, and because there's a lot of people looking the other way. In terms of COVID, all the agencies have debt service reserves on acquisitions, refinances, new constructions. Those debt service reserves are On a new construction project, what on a $40 million loan, what may have been 9 months, you have to expect 15, in some cases 24, if it was related to age-restricted housing. I mean, that's a hard product to give consideration to right now. Our portfolio of assisted living in some markets what has happened is it's beyond tragic. And we're talking, we're talking about more than 50%, sometimes 60% of the residents have contracted, have gotten COVID, and it's sad to watch what's happened in some states here in our portfolio. But for the most part, the multifamily has been really resilient.
Great. Well, we're getting some questions in from the audience, and we're in that section of time where it is audience questions. So we'll go through the list. There was one here, it was actually for me, asking why a lot of those apartment searches were from the DC area. I think that was taken really early on this. I think what we're hearing now is a lot of the residents actually showing up are from the New York area and some of the larger cities. Why we had so many from DC. I mean, we have a great office on multifamily in DC. The fundamentals are great there. They have Amazon and so forth. So I don't know if we have an exact answer for that. Maybe a lot of people from the administration earlier on in the year were let go of their jobs and they're looking to relocate. But I don't know what else it could be, except for major metropolitan areas seem to be attracted to Denver. So we'll keep going through some of these questions. Let's see. So I'll throw this out to the crowd. So what do you like about multifamily development today, and what keeps you up at night? Let's start with you, Amy.
I'd just say force majeure clauses don't keep me up at night. It's super boring. No, it's a joke. I will tell you, I'm sleeping better now than I was in March and April. March and April was a really stressful time for all of my clients. The uncertainty on, can we continue to construct? Will we be shut down? What do we do if a tenant has COVID? Can we tell anybody? Can we send our service people into the units, to do maintenance? How do we protect our employees? And those were really serious questions that the people on the ground trying to deal with it had a lot of stress over. And, I think the good news is it feels like people are settling into this a lot more and have developed protocols. I think the multifamily industry through NMHC and otherwise, and places like NAIOP, have shared a lot of good information on how to deal with operations. But those first 2 months, it was like a question of first impression, not every day, like every 10 minutes. And I know that all of the people that are in the industry were feeling it really intensely.
Carl, how about you? What do you like about multifamily today, and what keeps you up at night?
So, for me, what I like about it is what I've always liked about multifamily is that it's probably the safest of the asset classes, right? I mean, everybody's going to need a place to live. I love that it's inflation protected for the most part. Your short-term leases, you're not locked in to folks. You've got a variety of different tenants with different credits, right? So you just protect yourself by the asset itself. And it's something that I wish we would do more of because it is so attractive. It's tough for groups like myself that use primarily our own equity to make sense of the return threshold in the multifamily realm. But because the institutional guys love that asset, and for the same reasons I think that I just listed. What's keeping me up at night is I think there's a little bit of a disconnect, certainly between the stock market and what I sense is the economic reality, mainly because there are major industries that are still pretty much shut down: travel, tourism, entertainment. right? We were talking with a movie theater in February about a potential deal. I don't know if that'll ever happen. So I think that there is sort of an underlying issue in the economy that hasn't really bubbled to the surface. And what keeps me up is that, right now, if we're able to get back through it, I think there'll be a relatively quick rebound. If there is a financial contagion, for lack of a better phrase there, some underlying financial fundamentals that are broken in the market like we saw in 2008, we're in for a longer haul than I think a lot of us realize. There'll be opportunities there, but that's what keeps me up at night is there some part of this that we aren't seeing, that not many people are seeing yet, that's going to keep us in a recession for a little longer. So nothing focused on multifamily per se, just general market.
Okay. How about you, Jarvie?
Yeah, I don't want to repeat everything that Carl just said, but a lot of what Carl said regarding multifamily, I agree with. We've had a 50-year run, and it's been a pretty steady, safe place, some highs and some lows. From a keep you up at night, we probably don't have enough time, but I think, like everything that Amy said, in March and April, we were worried about. We had an equity partner leave us at the altar on a deal that keeps you up at night. So securing equity and debt relationships with, pre-development shares is the recipe for that. And that was a deal that we did not. On the positive side, contrasting what Amy pointed out about will things get shut down. I won't even get into operations because that has been a lot of sleepless nights. But the good news is in a global pandemic like this, the construction industry has been deemed essential, and that feels really good. Carl and I felt some pain in the city of Boulder for about a 30 to 40 day period there where we could not get inspections because of how the city of Boulder was treating, the state ordinance. But for the most part, we stayed pretty well, in business, pushing. I think Mayor Hancock made a good observation about the number of construction-related jobs, and that was positive. So that does kind of help you sleep at night a little bit. We have also been sort of to the similar point that Carl made, cognizant about what's going to happen when the unemployment checks stop coming in. We've been watching collections daily. We've been cross-referencing them monthly and annually, and I'm going to knock on wood. Denver, the near-term data for Denver has been good. You said it, Terrance. In the mid 90s, north of 96 in most of our assets. So that feels good. But I mean, I think there's a lot of things in the development business that keep you up at night. You just kind of know that going in, and there's a reason. I think it was Cowan. He said it, Terrance. That the happiest folks in real estate are the folks that don't build anything. There's sometimes truth to that, but there's a reason that Carl and I love the business because of the problems we solve and the rewards at the end.
Yeah, seeing things come together. Okay, well, we're coming up on time, so let's do one last quick hit question. Let's take a real interesting one. We've got a lot of people coming into the business right now, so we have probably out in the audience the next Amy, Jarvie, Carl, and Scott. So real quick, kind of one bit of advice you could give someone that's just starting in the business. So let's just rephrase it. What advice would you give yourself when you just started in the business, if you could look back? I'll start with you, Amy.
I'm a strong proponent of really strong work ethic, and being really curious, right? So if you have a strong work ethic and you pair that with kind of an intense pursuit of the subject matter, at least for the lawyers out there, that's going to be a really strong combination. If you're not intellectually curious, all the strong work ethic in the world is not going to help. And if you don't have a strong work ethic, you can be as curious as you want, but you need both. I'm sure there's a lot of other things I could have learned over the years, but those are the two that come to the top of mind.
How about you, Carl?
So I'd echo that, especially because, in Jarvie and I's day, we'll wake up in the morning and fight with a civil engineer about, how much import-export is needed. And then, end the day fighting with a municipal inspector about, so there's just, you've got to have an interest in all aspects of it, be a sponge for details. The thing I'd add is I wish I'd been a little better at understanding and picking vendors and teams. You want to get, look, because of, at least in my role, I can't be an expert on everything. I've got to have the right experts in place to help me get to where I want to go. And that is a constant struggle because each project is going to be different. And there's, you may have a really good civil engineer that knows the Denver process really well, and you take him up to Thornton and he has no idea what he's doing. So those are the types of things that I wish I would focus on more. Who is the team that I'm building for this project to make it as successful as it can be?
Right. Scott, how about you?
I would say research on the subject matter or the area in the industry that you think you want to pursue, and target the companies that are in that environment and reach out to them directly. And understand the company a little bit before you have initial discussions with them, so that you look prepared even before there might even be some sort of interview process, and being very tenacious about it. Right now, I guess the best advice I could give anyone, it would be to be patient, because it's going to be very hard for any company to take on new people because they don't have the ability to train in person, and that culture that you want to establish for the new employees is hard. It's near impossible to do in this environment. I mean, maybe you guys have been successful, but our ability to train is just been eviscerated because you need to be. It's very hard to train certain aspects of the business, certain techniques, certain communication processes through this platform. And I guess we all have to be able to adapt and be dynamic, but patience probably right now is don't be discouraged. And, this too will pass. Don't go to school for this and then just decide to go another path. So.
Right. Jarvie, finish us out.
I agree with a lot of what was just said, and I had some good advice from mentors early on. I think everybody on this call knows or should know this is an extremely experiential business. You just heard it from 3 experts, and sometimes those experiences can be very intimidating at a young age. I think it's important to remember that asking questions is not always a bad thing. Asking the same question twice sometimes is. But you grow in this business by realizing that you're going to encounter situations that are very different from the last project that you did. Carl and my experience in entitlement on one deal is very different than the next, and you don't understand it unless you ask questions. And that goes for construction and consultants. So I think just kind of being open to that, Amy said that learning process, but also being confident and comfortable in new experiences and asking the questions that get you kind of the information that you need. And I just think it's a challenging business. I think, Scott pointed it out. I try to always kind of lean forward and stay positive and know that we're going to find a solution to the problem. And sometimes that can be discouraging, and you have to sort of separate on your work-life balance, how not to bring that home, because you will never stop thinking about development. The day doesn't stop at 5, but you do need to sort of learn how to separate that. Kids are a good, healthy way to do that and get distraction from that. I think that's sort of high level. The last thing I would say, and Carl pointed out about the funnel of finding new deals early on in the call. I got advice early on that, you can't fall in love with something that's not going to love you back. And oftentimes you look at a deal, you see a property, you look at the architecture, and you just say, I got to get this done. And you can't blur the analysis. You have to let the analysis speak for itself. And, you know, are there some emotional projects out there sometimes that you can reach for? Certainly, but just being disciplined in that sort of guidance, I think, has been good advice. It also helps you when a deal falls out from underneath you and you're really upset about it. I've had a couple of those to just kind of move on, you know, like athletes forget the last play and move. Terrance, you're muted, man. Terrance, I think you're muted.
Once again. Also, I think tenacity goes a long way. Anyway, we did have one more question that did come in quickly that had been there for a while. So I was told to ask it. And it really had to do with some of the peer cities that people are attracted to and how Denver competes with them. You know, from my infinite amounts of just having conversations about what's going on in the world on national calls, I can take a stab at where investors are looking and where people seem to be searching and companies seem to be searching. And some of the peer cities to Denver would be Austin, Nashville, Carolinas, to some extent. Dallas is doing pretty well. I think people are attracted to different cities for different reasons. You know, lifestyle seems to be a common theme. A lot of the mountain states overall are doing well, but Denver being the anchor is seeing more of the people looking to either relocate here company-wise. I think work from home going forward is a hot topic, and Denver is a great city to be a benefactor of that. We've seen, you know, companies like Home Advisor, who's been here, they've been expanding since they've got here, and they're putting 2 floors back in a sublease while they're still escalating hiring, meaning they're going to do more work from home. You're going to see another big announcement from a work from home company taking big office space. So I think you'll see companies attracted to Denver and lifestyle cities where there will be a big work from home component, but people will be coming into the office. Denver has better transportation airport than Austin. If you don't like snow, Austin's probably a place to be, or Nashville. But just in a nutshell, Denver competes very well. Some cities are going to have better tax bases. Texas, I mean, you know, the income tax, so forth, is a benefit. Florida as well. So that is a quick hit. If anyone else has anything to add on that, I am going to turn it back over for closing statements and ask Brian to jump back in. And thank you, everybody. A great session. Hour and a half went quick.
Thanks, Terrance, and thanks to all the panelists for sharing your time and expertise today. We once again want to acknowledge today's program sponsors, Transwestern, the Whites Company, and Polsinelli. Please, all the attendees, complete the post-webinar survey, which you'll receive in your email, and visit the NAIOP website at naiopcolorado.org for details on upcoming events and programs. A recording of today's webinar will be available on the website later today. Mark your calendar for September 16th, which is our next session in the educational series, Mind the Development Gap. That will be our industrial session, and registration is open now. Thanks again for joining us today. Have a